Welcome to another TCP walkthrough video. I'm Logan, and in today's video, we're going to be going over calculating realized and recognized gains for non-cash property contributions, and by the way, that's in the context of shareholders and C corporations. And we're going to be doing that the superfast CPA way, which is diving straight into questions to learn the material. If you don't know much about our strategies, make sure you go to SuperfastCPA.com and check out our free 1-hour webinar training. We teach the key ingredients to passing the CPA exam and being effective and efficient with your study time. It's something you don't want to miss, so make sure you go check that out. The link will be in the description. Also, just letting you know, we will only be going over 5 questions in this video, but Superfast CPA members will have access to the full 10-question video when we post it in the members forum. So, if you like this, you can get more of it by becoming a Superfast CPA member. With all that said, let's dive straight into the questions. Okay, here we are at question 1. John transfers a piece of equipment with a fair market value of $100,000 and an adjusted basis of $60,000 to Alpha Corp in exchange for 87% of Alpha Corp's stock. Assume no other transactions occurred. What is John's recognized gain? Okay, so this is the first question of the video, so let's go ahead and dive straight into the answer to start learning. Okay, and the answer is actually $0. There is not a recognized gain in this situation, so let's read through this. When non-cash property is transferred to a C corporation in exchange for stock, and the transferor or transferors immediately control or controls 80% or more of the corporation, no gain or loss is recognized by the shareholder. So in this scenario, John transfers equipment with a fair market value of $100,000 and an adjusted basis of $60,000. He receives 87% of Alpha Corp's stock, thus he meets the 80% control requirement, therefore no gain is recognized. So let's walk through this a little bit more. So there is a realized gain. The realized gain is calculated as the fair market value of the property received plus any assumption of liability plus boot received. And by the way, boot is usually just extra cash on top of the stock, all minus the adjusted basis of the property transferred. So again, that's the fair market value, which is $100,000 in this case. There was no assumption of liability or boot received, so we don't need to worry about those. And then we subtract the adjusted basis, which was $60,000, and that means that there was a realized gain of $40,000. Again, there was a gain. But as far as tax is concerned, it's not recognized, meaning it's not taxed. So there is a realized gain, but because he had more than 80% control of the corporation from this transaction, that means there was no gain recognized. Now, one note, if boot, which again is usually cash or other property received besides stock, was received by John, or if Alpha Corp assumed a liability greater than the adjusted basis of the property transferred, then a recognized gain could occur. Since John meets the control requirement and no boot or liabilities exceeding the adjusted basis are involved, the recognized gain is still $0. So this is just an intro into some of the rules here. Again, we're going to be dealing with realized and recognized gains for shareholders in C corporations. And we're also going to talk a little bit about what the basis is for the C corporation in the property it received. So let's go ahead and dive into the next question. Okay, here is question 2. Mary transfers a building with a fair market value of $500,000 and an adjusted basis of $300,000 to Beta Corp in exchange for 85% of Beta Corp's stock with a fair market value of $250,000 and $50,000 in cash. Additionally, Beta Corp assumes a mortgage of $200,000 on the building. What is Mary's realized gain and recognized gain? Okay, so we learned how to do the realized gain in the previous question, which again is just the fair market value plus cash plus any liability assumed less the adjusted basis. So you should remember that from the previous question. But we didn't really deal with boot or anything like that in the previous question, whereas now there is something that would cause boot, so therefore there would be a recognized gain. So if you want, go ahead and pause the video, see if you can think through this just based off what we learned from the first question. If not, let's go ahead and look at the answer to learn how this works. Okay, kind of a big explanation here, but D is the correct answer. There would be a realized gain of $200,000 and a recognized gain of $50,000. So again, let's walk through all this. So like we learned originally, when non-cash property is transferred to a C corporation in exchange for stock, and the transfer immediately controls 80% or more of the corporation, no gain or loss is recognized. However, if boot, such as the cash that we're seeing in this problem, is received, then a gain may be recognized. Liabilities assumed by the corporation only affect recognized gain if they exceed the adjusted basis of the property transferred. So in this scenario, she transferred the building that had a fair market value of $500,000 and it had an adjusted basis of $300,000. And this is what she received in exchange for that. She received stock, which was valued at $250,000, $50,000 in cash, and Beta Corp assumed a mortgage of $200,000 for her. So let's go down here to the realized gain. The realized gain, again, is the fair market value of what was received. So that would be the stock, the cash, the liabilities assumed. So the $250,000 of stock, the $50,000 of cash, and the $200,000 liability assumed by the corporation. All that together, less the adjusted basis, gives us a realized gain of $200,000. Now again, that's just the realized gain. For tax purposes, that doesn't necessarily mean it's the recognized gain in these situations where the shareholder controls 80% or more of the corporation. So let's go down here to the recognized gain. The recognized gain is the lesser of the boot received, and in this case, that's the cash. And usually, by the way, it's almost always cash. I almost never have seen a boot that's, quote unquote, other property, although I've heard it mentioned. Almost always, cash is the boot. You can have moments where the liabilities exceed the adjusted basis of the property, but most of the time it is cash. So it's the boot received, which is cash, or the realized gain. In this case, the cash was $50,000, so that's the boot. And again, the recognized gain is the lesser of the $50,000 boot or the $200,000 realized gain, so obviously it's the $50,000. So even though there was a realized gain of $200,000, and even though Mary controls more than 80% of the company, because there was this boot received of cash on top of the stock, that is the recognized gain. Also remember, like I was mentioning before, that if the liability assumed, which was this $200,000 up here, actually exceeded the adjusted basis, which is this $300,000, of the property transferred, then the amount over the adjusted basis would actually incur a recognized gain as well. So again, for example, if this $200,000 liability assumed was actually $400,000, then that would mean that would be $100,000 greater than the adjusted basis of $300,000, and that would give you $100,000 of recognized gain from the liability assumed. But again, that is only if the liability assumed exceeds the adjusted basis of the property transferred, and that is not the case in this scenario. So overall, the realized gain was $200,000, but only $50,000 of it is recognized for tax purposes. Okay, learned a lot from that question as well, so let's go to the next question. Okay, here is question 3. Alice transfers a piece of land with a fair market value of $300,000 and an adjusted basis of $180,000 to Gamma Corp in exchange for 75% of Gamma Corp's stock and $40,000 in cash. Additionally, Gamma Corp assumes a mortgage of $50,000 on the land. What is Alice's recognized gain? Okay, very similar to what we've seen before, although one thing to remember is we've been talking about 80% or more of ownership. This says only 75%, so how is that going to affect this? If you have a guess, that's great. Go ahead and pause the video, see if you can figure it out. If not, again, let's dive into the answer to learn how this works. Okay, the answer is actually $210,000. So let's dive into this different situation. When non-cash property is transferred in exchange for stock, if they have 80% or more control of the corporation afterwards, then the gain isn't recognized except for the situation where we just talked about, the cash, the boot, and things like that. However, if the transferor does not obtain 80% or more control, the recognized gain is actually equal to the realized gain. So if you don't control more than 80% of the corporation after this transfer, that means that the recognized gain is the realized gain. And in this case, the realized gain is that $300,000 fair market value plus the cash received plus the $50,000 liability or mortgage assumed less the adjusted basis, giving you $210,000. Again, that is because she didn't control more than 80% of the corporation from this transfer. So that just goes to show how much of a difference it can make if somebody does own 80% or more of a corporation from transferring non-cash property to the corporation, because they can defer that gain being recognized immediately. And that's why this whole rule exists. All right, we learned a little bit more. Let's go to the next question. Okay, here is question 4. Bob and Carol decide to form Delta Corp. Bob transfers machinery with a fair market value of $200,000 and an adjusted basis of $120,000 in exchange for 50% of Delta Corp's stock. Carol transfers a building with an FMV of $300,000 and an adjusted basis of $180,000 in exchange for 50% of Delta Corp's stock. Together, Bob and Carol own 100% of Delta Corp. What is Bob's recognized gain? All right, we've learned all the rules behind this pretty much up until now. However, the question comes in, since Bob only has 50% ownership, does he qualify to not have his gain recognized in this year? How does it work when two people form together at the same time? Let's go ahead and look at the answer to figure this out. Okay, the answer is, again, $0. Bob does not recognize a gain. So let's read another rule. The control requirement can be satisfied by multiple transferors if they act together to form the corporation. This applies both during the formation, and it can also apply with subsequent ownership changes, like if owners work together to change the ownership or purchase ownership in a corporation. Overall, provided that the control requirement is met immediately after the exchange. So two people, even though Bob only has 50% and Carol only has 50%, since they're working together and forming the corporation at the same time, this does meet the 80% control requirement, even though they both only own 50%. Overall, they own 100% of the corporation. So there's this whole calculation here for his realized gain, but in the end, it doesn't matter because Bob has no recognized gain because they have more than 80% control of the corporation. So a little bit confusing. I thought it was confusing when I first was learning this, but multiple transferors can work together to reach that 80% ownership for control. All right, let's go to the next question. Okay, here is question 5. John and Lisa decide to form J&L Corp. John transfers $100,000 in cash in exchange for 50% of J&L Corp's stock. Lisa transfers a piece of equipment with a fair market value of $150,000 and an adjusted basis of $120,000 in exchange for 50% of J&L Corp's stock and $50,000 in cash. What is the basis that J&L Corp has in the equipment? Okay, everything else we've talked about has dealt with the shareholders' realized and recognized gains, and this does still deal with it because that can affect the basis that the Corp has in the equipment. But now we have to figure out what the basis is that the Corp has when they receive that equipment. What is their basis in the equipment? So if you know about this, that's great. Pause the video and do the calculation. If not, again, we're going to dive into the answer to learn how this works. Okay, here is the answer, and there's a lot of text here, but it's actually pretty straightforward. So let's kind of walk through it. The answer is $170,000. That's the basis that the corporation is going to have in that equipment. And the basic rule that all of this explains is that the basis of the property in the hands of the corporation is the same as the adjusted basis in the hands of the transferor, increased by any gain recognized by the transferor on the exchange. So in other words, the corporation's basis is the adjusted basis that the transferor had plus any recognized gain that the transferor recognized. So with all that said, let's dive into this a little bit. First off, they do own 100% of the corporation together, so they meet that control requirement. So we're not dealing with the recognized gain being equal to the realized gain. So first we have to figure out what the realized gain is. And in this case, it's everything she received, the stock and the cash, less the adjusted basis, giving us a total of $80,000 realized gain. And the reason that that's important is because we do always want to compare the realized gain to the potential recognized gain, because again, as a reminder, we didn't really see it in this video, but the recognized gain is actually the lesser of the realized gain or the boot received. So in this case, luckily the boot received is less than the realized gain. The cash is $50,000 and the realized gain is $80,000. So we take the $50,000 as the recognized gain. But there are situations where the boot might actually be bigger, like the cash might actually be larger than the realized gain. And in that case, you actually do take the realized gain as the recognized gain. But that's not the case here. So $50,000 recognized gain. And that all matters because now we go to the adjusted basis that the corporation has, which is this $120,000. And we add that recognized gain that Lisa had. And that is the total basis that the corporation has in the property that it received. So again, it's the adjusted basis plus the recognized gain that Lisa had, $170,000. Okay, we learned a lot through the past 5 questions. A whole bunch goes into this. Before we go any further, let's do one more part of the process called pillar topics. Now, the idea behind pillar topics is as you're going through the questions to learn the material, you will notice the things that keep popping up, the topics that your review course is obviously trying to teach you because you've seen that equation or you've seen that topic pop up 3, 4, 5 times throughout the questions that you've been doing that day. So you know it's important, so you write it as a pillar topic so that you can know it for later. So let's go ahead and look at the pillar topics for this video. Okay, here are the pillar topics. So first off, there is that 80% control requirement. When non-cash property is transferred to a C corporation in exchange for stock, and again, only for stock, no gain or loss is recognized if the transferor or transferors together immediately control 80% or more of the corporation. And that actually can apply with multiple transferors. Remember that multiple transferors can combine their contributions to meet the 80% control requirement, allowing for non-recognition of gain if they collectively control 80% or more of the corporation immediately after the exchange. Now, as far as realized gains go, the realized gain is calculated as the fair market value of the property received plus any cash received and the liabilities assumed by the corporation minus the adjusted basis of the property transferred. Now, when it comes to the recognized gain, and again, this is all in the situation where it's the 80% control or more, if the boot, which again is usually cash or other property on top of the stock, is received, the recognized gain is the lesser of the boot received or the realized gain. Now, when it comes to situations where there is not 80% control, then the recognized gain is actually equal to the realized gain. They don't get that benefit of deferring the recognized gain. And finally, the last thing that we covered, the corporation's basis in the property that it receives is the adjusted basis in the hands of the transferor plus or increased by any gain recognized by the transferor on the exchange. All right, with that, those are the pillar topics, and that is the end of the video. Make sure you check out our free 1-hour webinar training on SuperfastCPA.com. Again, it's only 1 hour, it is free, and we will teach you the strategies to passing the CPA exam efficiently and effectively. If you liked going through these 5 questions with me, just remember that Superfast CPA members will have access to the full 10-question video when we post it in the members forum. So if you like this, you can get more of it by becoming a Superfast CPA member. If you liked the video, make sure to like it and leave a comment. I hope this was helpful, and I will see you in the next video.